Let me now bring on board Sanjeev Prasad, Senior Executive Director and Co-Head with Kotak Institutional Equities. He joins us live from Singapore. Sanjeev, morning. Thank you for joining us. Sanjeev, FOMC has turned out to be a no-show event and markets have moved on. What is your assessment?
Sorry, what was that again?
The US Fed or the FOMC meeting last night has turned out to be a no-show event. The world was leaning on it. Everyone expected that, after QE2 or QE3 would come. Nothing has come out of it and markets have moved on.
Well, I guess the Fed is also being careful, because so far the data in the US is still okay. It's not very bad. So it probably means that it is keeping its powder dry for some time, before the really bad news starts coming out. The Eurozone problems are clearly not getting over in a hurry. Things could potentially worsen over there. And even the US, keep in mind the fact that next year is going to be pretty tough for the US, primarily on account of the fiscal cliff it is facing. You have a lot of defense budget which is getting cut next year. Plus you have the Bush-era tax cuts expiring, which means that consumption in the US could potentially slow down next year. So I assume you could see some sort of Fed support coming in more closer towards the end of this year, early part of next year, than maybe in the second half, unless and until the Eurozone problems deteriorate significantly and the Fed has to step in. This goes back to the main point that I think the markets have to stop relying on the central banks doing something to bail them out. In the sense people keep on hoping that the RBI will cut policy rates, Fed will come out with some round of QE3 or some other thing. In the Europe, its expectation will TRO, and clearly the politicians and the governments are not playing the part. So I think that's where we are. I think it's better that we stop hoping that central banks will keep on injecting, as I call it, steroids into the market.
So Sanjay, what is the next trigger for Indian markets to move anywhere from here? We're done with the RBI policy, we're done with the Fed, and we pretty much know what's happening with the monsoon as well.
Correct. On the positive side, what we would like to wait and see is what's happening in terms of fuel prices increases, if any, as far as diesel is concerned. And if the government can muster the courage once you have the presidential elections out of the way, you have a new finance minister, hopefully you could see one round of price increases at least, and that is pretty critical. Even though oil prices have come off, we are still nowhere in the comfort zone as far as the fisc is concerned. So if the government can muster the courage to raise fuel prices, I think that's a good indication that the government is trying to get to grips as far as the challenge in the domestic economy are concerned. The second thing which all of us have to watch and wait for is what's happening to monsoons. It's obviously very disappointing, the first 2 weeks of data which has come out. And if that doesn't improve, then I think your GDP numbers, which are already quite low as far as consensus numbers are concerned, they could get cut even further, which is definitely not good news as far as the markets are concerned. The third thing which I would wait and see again is what's happening on the politics front, whether we can get sufficient consensus for some of the reform measures to go ahead, and particularly I would focus on the GST reform. Looks like there is some consensus emerging finally between the central government and the state governments, and hopefully that goes ahead. Politicians keep out of it, and hopefully that gets implemented by 1st of April 2013. So I think those are the few positives that we can hope for in this market, and it's like that government will start giving some signs of good governance.
Sanjeev, the bulls are of the view that whatever could go wrong has gone wrong in last 3 months. Currency, macro environment, GDP growth, we've got a Fitch downgrade and a warning from S&P. But still markets are holding on. We are a good solid 10-11% above the December high.
Well, I don't think that is correct. A lot of things could potentially still go wrong as far as India is concerned. First thing, the rating itself, remember, it is still the threat of a downgrade. We haven't yet been downgraded. It's only the outlook that has been downgraded. If we, actually get downgraded, it's going to be, I think, a catastrophic event for the simple reason we are going into junk bond status in that case. And what does it mean for investments in India, particularly on the fixed income side? Are investors still going to be in a position to keep the money in India? So that's something which the Indian government has very seriously, introspect about and, come out with steps that can, allay these concerns which the rating institutions have rightly pointed out, somehow we are in our own world that, everything is fine with us and we will continue to do our own things and the world will continue pardoning us. I don't think that's the case any longer. So first thing to worry about is it's a downgrade itself, not just a downgrade as far as the outlook is concerned. Second thing is we have monsoons which are still, looking very dicey as of now. So if this thing does not improve over the next 1.5 months, and I think you will see a fair amount of downgrade as far as the real economy is concerned. Third thing is on NPL cycle as far as the banks are concerned, I think there is still a serious issue of NPLs out there. Most of us have taken the view that the NPL cycle is largely peaked. My own view is that there is still a lot of bad loans yet to come out there, particularly in the power sector. The banks are doing all sorts of stuff in terms of cleaning their books, restructuring of loans, which I think is absolute rubbish in my view. They should be treated as NPLs rather than as restructured loans. And it creates a lot of, issues in terms of the behavior of lenders and borrowers. The moment you give an escape route, you have a problem anyway. And are we really seeing signs of improvement that just because you bought some time in terms of restructuring of loans, does it mean that the underlying issues have been addressed? And my answer is really no, particularly in the power sector. You don't have fuel to power many of the new power plants which are coming up. You don't have gas, obviously. You're not addressing the problems on the distribution side. So why are people so bullish on the NPL cycle as far as the banks are concerned? I would be seriously concerned about the NPL cycles in the banking space.
Sanjeev, let's talk about a space that you track very carefully, oil and gas stocks, especially OMCs and the kind of run-up that we've seen in the entire pocket. Crude's been cracking, there have been octroi changes as well, and buzz of a diesel hike. Do you see further upside in these names?
See, these are stocks which always trade inversely related to the crude price. So if crude prices keep on coming up, the stocks will keep on rallying. But having said that, do their earning numbers really change? The answer is no. First of all, nobody even knows what the real earning numbers of these companies are. You have to take a guess at best, given the fact there is no clarity on the subsidy sharing mechanism. But even if you take some assumption that the government will give sufficient amount of money as far as the budget is concerned, the fact that if crude prices come down, I think it's the government and the upstream companies which stand to benefit the most. Given the fact that, if you recollect last year, oil companies, that is the downstream oil companies, had a total under recovery of something like 49 billion rupees on gasoline. They didn't have any under recovery on diesel, kerosene, LPG. This year around, I would think their under recovery would be in a similar zone. If not on gasoline, it would be on diesel, LPG, kerosene. Clearly we're not seeing a situation where crude prices are going to correct so much that there will be no recovery for anybody. So the more important thing is, yes, overall under recoveries may come down, but under recoveries for the upstream companies and the government will actually come off a lot more than what it would come for the downstream companies. The downstream companies, I don't think crude prices really matter. What really matters is the net amount of under recoveries for them. That is the total under recoveries, less whatever is the share of the government and the upstream companies. So I don't think, this really matters. It's more of a sentiment thing. People just get excited about crude prices going up and going down, and accordingly, place their views, as I said, in an inverse relation to crude prices. But fundamentally, I don't think anything changes for them. If anything, it's a positive more for the government's fiscal position and for the upstream companies. One more point, just keep in mind the fact that it's only a few days. Your average crude prices as of now will still be higher compared to last year's crude price. Last year, the average crude price was more like 113. The first 2 months of April, May, your average crude price was somewhere about 115.5. So crude prices have to stay here for an extended period of time for even the government and the upstream companies really benefit in any meaningful way. Ultimately, you have to have a situation where you allow prices to rise, and that's the way to tackle the under recovery. Is not to keep on hoping that somewhere crude prices will come down and remain low, and that will solve our problems.